Welcome back, traders. In today's video, we are going to look at one of the cleanest smart money concept setups on the 1-hour time frame. I will walk you step by step through two important breaks of structure: how to correctly identify the institutional order block, how inducement forms before the real move, and how to target sell-side liquidity with precision. By the end of this video, you will understand exactly how institutional price delivery works, and I will also show a short example of how the same concept repeats on gold. So make sure you watch this entire breakdown very carefully, because every part of this setup is connected. We begin by looking at the left side of the chart. Price is moving slowly upwards, but the candles are weak and corrective. There is no strong buying pressure, and the market is clearly struggling to create a higher high. Then we see a sharp drop in price. This drop breaks below the previous swing low, giving us the first break of structure. This moment is extremely important because it confirms that the temporary retracement is over and the dominant sellers have stepped back into the market. Whenever we see the first break of structure in a downtrend, it tells us that the market is ready to continue lower. This gives us our initial directional bias. We are now focused only on selling opportunities. No buying, only selling. After the first break of structure, price does not move straight down. Instead, it pulls back slightly and tries to climb, but this pullback is weak and the candles lack momentum. Then price drops again and breaks another important swing low. This creates the second break of structure. Two consecutive breaks of structure in the same direction confirm the strength of the trend. This second break tells us that institutional order flow is heavily bearish. It also tells us to prepare for a possible return to a premium zone, because price usually pulls back after breaking structure to collect fresh liquidity for the next move. Once we understand that the trend is bearish, our next job is to locate the institutional order block. We look for the last bullish candle before the major impulsive drop. That candle forms the bearish order block. This is where institutional traders placed their large sell positions. Price often returns to this order block because it is an area where unfilled orders still remain. When the market retraces back into this zone, it gives us a perfect opportunity to join the institutional traders. On your chart, the order block is very clean, and price respects it beautifully. This is exactly the place where a professional trader waits patiently for a high-probability sell entry. Before price taps the order block, it creates something very important: inducement. Inducement is designed to trick retail traders into entering the wrong direction. Price pushes above a small previous high. This move grabs liquidity from traders who entered long early. It also takes out stop losses from traders who sold too early. This small manipulation creates the fuel needed for institutions to push price in the real direction, which is down. The inducement is the signal that the market is preparing to touch the true point of interest, which in this case is the bearish order block. Now that we know where to enter, we must identify where the market is going. Below the current price, we can clearly see equal lows. Equal lows are a magnet for price because they store a concentration of liquidity. Retail traders place stop-loss orders under those lows, and institutions aim for those stops. This area becomes our sell-side liquidity zone. It is the place where the market wants to deliver price. So now we have the complete model. Trend direction, bearish. Two breaks of structure confirming the trend. Order block as the entry zone, inducement before entry, sell-side liquidity as the target. This is a complete smart money concepts trade. When price completes inducement and finally returns to the order block, that is the moment of truth. Price taps into the order block, reacts instantly, and begins forming strong bearish candles. This is where we execute our sell trade. From here, the market moves exactly as expected. Slow and steady push downward, then stronger bearish momentum finally reaching the sell-side liquidity pool. The market hits the equal lows, clears all liquidity, and completes the institutional trade model perfectly. This is how professional traders enter with precision and exit with confidence. If you want more deep smart money concepts breakdowns and want to master institutional trading models, make sure you follow Discount Trader for more complete step-by-step explanations. Thank you for watching, and I will see you in the next video.